A person with a high credit score can walk into a bank and borrow hundreds of thousands of dollars. A person with a low score might get rejected for a basic apartment lease. Same country, same currency, same economy, completely different access to reality. And what's strange is that most people accept this system without ever asking a more uncomfortable question. What exactly is the score measuring? Because banks say it measures responsibility, but if that were completely true, the global economy would not become stronger when people borrow more, and yet it does. Consumer spending drives enormous portions of modern economies. Housing runs on mortgages, cars run on financing, education runs on loans, business expansion runs on credit. Even emergencies increasingly run on debt, which creates a strange contradiction. The system publicly praises financial caution while structurally depending on mass borrowing to keep growing. And somewhere inside that contradiction, your bank assigns you a number, not just to predict risk, but to calculate participation. Because the score quietly determines how much debt the system believes your future can absorb. And once you notice that, a lot of modern life starts looking different. The apartment approvals, the spending incentives, the endless pre-qualified offers, the invisible ceiling over some people, and invisible acceleration under others. It stops feeling like a customer service tool and starts feeling more like infrastructure. A ranking system for economic participation, a system where your ability to access life increasingly depends on how efficiently you can carry debt. And the strangest part, most people never actually see the real ranking logic at all. They only see the final number, 3 digits. As if the entire financial system just magically condensed your economic existence into a score between poor and excellent. But underneath that number is a much larger machine. And the machine is not designed merely to protect banks from bad borrowers. It's designed to organize debt at scale, which matters a lot more than most people realize right now. Because over the last few decades, debt stopped being just something people occasionally used. It became the operating fuel of entire economies. And once that happens, banks stop evaluating people like customers. They start evaluating them like long-term economic assets or liabilities, sometimes both at the same time. Which is why 2 people earning the exact same salary can end up living inside completely different financial realities. One gets low interest rates, fast approvals, higher limits, better insurance pricing, easier housing access. The other pays more for almost everything, not because they are necessarily irresponsible, but because the system predicts different long-term profitability profiles. That's the important shift. The score is not simply judging your past, it is estimating your future usefulness to a debt-driven economy. And historically, this system became far more important than it was originally supposed to be. Credit scoring in its earliest forms was surprisingly primitive. Banks used local judgment, personal relationships, reputation, sometimes even appearance, which sounds absurd now. But financial systems have always tried to convert uncertainty into measurable patterns. By the mid-20th century, consumer lending exploded. Credit cards expanded, suburban housing boomed, mass financing became normal. Banks suddenly faced a scaling problem. You cannot manually evaluate millions of people one by one while simultaneously trying to expand lending nationwide. So the industry needed standardization, not fairness necessarily, efficiency. That distinction matters. In 1956, engineer Bill Fair and mathematician Earl Isaac created what would later become the foundation for modern credit scoring systems. The idea was deceptively simple: use statistical models to predict who would reliably repay debt. At first glance, that sounds reasonable, but over time the implications became much larger than repayment prediction alone. Because once a system can statistically estimate borrowing behavior, it can also shape borrowing behavior. And once entire economies become dependent on credit expansion, those predictive systems become economically strategic, not just financially useful. That's when the score quietly evolves from a banking tool into social infrastructure. Today, millions of people organize their lives around maintaining this invisible ranking. They monitor utilization ratios, avoid hard inquiries, time payments carefully, keep old accounts alive. People literally modify behavior patterns to maintain algorithmic approval. And what's fascinating is how emotionally attached people become to the score itself. A number moves from 742 to 768, and someone feels successful, even though nothing physically changed. No new skill, no new asset, no increase in wisdom. Just increased approval probability inside financial systems. And yet emotionally, it can feel like progress. Because modern economies increasingly convert access into status. Higher score, more doors open. Lower score, more friction everywhere. That friction compounds quietly. Higher interest rates mean more money lost over time. Lower approval odds reduce flexibility. Insurance premiums increase. Housing becomes harder. Emergencies become more expensive. Being financially weak becomes expensive itself. Which creates another strange paradox. The people with the least financial flexibility often pay the highest costs to participate in the economy. And the system calls this risk pricing. Technically, that's true, but it also produces a self-reinforcing loop. Low score, higher costs, less financial margin, greater instability, more missed payments, even lower score. The system does not simply measure instability, it can amplify it. And this becomes more important once you understand how modern banking actually makes money. Because many people still imagine banks primarily as giant vaults protecting cash. That image is outdated. Modern banking is heavily tied to debt creation. Loans generate interest, interest generates revenue, revenue supports expansion. Which means a good customer is not necessarily someone who avoids debt completely. That would actually be less profitable. The ideal customer is often someone who carries manageable debt consistently, reliable, predictable, long-term, not collapsing, not escaping, just stable enough to continue participating. This is where the public narrative around credit scores becomes slightly misleading. People are often told, build your score to become financially healthy. But the mechanics underneath sometimes reward sustained borrowing behavior more than avoidance. Someone who never borrows may actually have a thinner profile than someone who continuously manages multiple debt products successfully, which sounds backward until you understand the system's priorities. The score is partly evaluating your relationship with debt itself. Can you carry it, manage it, normalize it, integrate it into daily life without disruption? That matters enormously in economies built around continuous consumption. Because spending drives growth, and borrowing expands spending capacity beyond immediate income. That expansion effect became especially powerful after the late 20th century. Wages in many sectors began stagnating relative to major living costs. Housing rose, education rose, healthcare rose. But consumer spending still needed to continue growing. Debt helped bridge the gap. Credit cards expanded purchasing power. Auto loans expanded transportation access. Mortgages expanded housing markets. In many ways, debt became the mechanism that allowed consumption to continue outrunning income growth. And when that happens at scale, credit scoring systems become critically important. Not merely because banks need protection, but because economies need calibrated borrowing participation. Too much reckless lending? Financial crisis. Too little lending? Economic slowdown. So the system constantly tries to balance expansion with stability, and your score becomes part of that balancing mechanism, which is why the ranking often feels invisible until suddenly it controls something important. A mortgage application, a business loan, an apartment approval, a financing rejection during an emergency. Then people suddenly realize the number was influencing life outcomes long before they started paying attention to it. And even then, most people still underestimate how interconnected these systems became. Credit scores can affect employment screenings in certain industries, insurance pricing models, rental applications, financing tiers, sometimes even relationship dynamics. People discuss dating preferences around financial stability now with surprising frequency. Think about how strange that is historically. An invisible institutional score increasingly influences social trust itself. And the more digitally integrated society becomes, the more scalable these ranking systems become too. Because modern financial systems collect enormous behavioral data: payment timing, spending patterns, debt ratios, account age, credit mix, patterns inside patterns. And increasingly, algorithms are not merely evaluating raw numbers, they are evaluating probability profiles, future behavior estimation. That's where things become philosophically uncomfortable. Because once institutions optimize around prediction, people slowly begin adapting behavior to remain predictable. You can already see this happening. Consumers strategically avoid closing accounts they no longer use. People carry small balances for activity. They fear applying for too much credit too quickly. Entire behavioral routines emerge around maintaining institutional confidence scores. And again, the irony is extraordinary. The system frames this as financial independence, while simultaneously encouraging long-term dependence on debt infrastructure. Not catastrophic dependence, managed dependence. There's a difference. A person drowning in debt threatens the system, but a population permanently integrated into debt ecosystems can fuel enormous economic expansion. That distinction matters, because modern economies are not designed around eliminating debt. They are designed around stabilizing it. And once you recognize that, a lot of financial advice starts sounding different. Build your credit, increase your limit, leverage responsibly, optimize utilization. Some of this advice is practical. Some genuinely helps people navigate reality. But some of it also trains people to integrate more smoothly into large-scale lending systems, which raises a difficult question. If debt participation increasingly determines access to opportunity, what happens to people who opt out? Historically, avoiding debt often signaled caution or discipline. Now it can create practical disadvantages: thin credit files, lower financing access, reduced flexibility during emergencies. In some systems, avoiding debt entirely can actually reduce your visibility inside the financial infrastructure itself, which is remarkable. Imagine explaining this to someone living a century ago. You must continuously interact with debt systems to prove you can responsibly interact with debt systems. It sounds circular, because it is, but the logic makes sense from the perspective of scalable financial modeling. The system wants data, predictable patterns, behavioral consistency, participation history. And the more dependent economies become on credit-fueled consumption, the more valuable that behavioral data becomes. This is also why financial systems became deeply interested in younger consumers: student loans, starter credit cards, buy now, pay later systems. Notice how early debt integration increasingly begins, not necessarily through force, through normalization. Debt becomes framed less as emergency financing and more as a default operating layer of adulthood. Monthly payments become permanent background noise: car payment, phone financing, subscriptions, mortgage, installments. An entire economic environment built around recurring obligations. And once enough of society functions that way, credit scores stop acting like optional financial metrics. They start acting more like citizenship layers inside the economy itself. Not official citizenship, functional citizenship. The ability to move efficiently through financial systems, which creates a quiet but important psychological effect. People begin optimizing not only for income, but for score preservation. Sometimes people avoid necessary financial decisions simply to protect the number. Others delay entrepreneurship because instability could damage lending access. Some stay trapped in financial structures longer than they want because exiting disrupts the profile. The score begins shaping behavior indirectly, not through law, through incentives. And incentive systems are often more powerful than direct force because people internalize them voluntarily. That's what makes modern financial infrastructure so effective. Most participation feels chosen, even when alternatives become increasingly difficult. And to be fair, credit systems do solve real problems. Lending at scale without risk evaluation would collapse quickly. Some form of predictive assessment became inevitable in large financial systems. That part is true. The uncomfortable part is how far the influence expanded beyond its original purpose. Because once a ranking system becomes deeply embedded, other industries begin using it too. Landlords reduce uncertainty through it. Insurers reduce uncertainty through it. Lenders price uncertainty through it. Eventually, the score stops being merely a banking tool. It becomes shorthand for institutional trustworthiness. And institutional trust increasingly shapes daily life, especially in digital economies where algorithms mediate access constantly. That trend may intensify even further in coming decades because predictive systems are becoming more sophisticated. Financial institutions now analyze vastly more behavioral information than traditional lending models once used, and artificial intelligence will likely accelerate that process dramatically. Not necessarily through some dramatic dystopian takeover, probably through something quieter, incremental optimization. More data points, better prediction models, faster behavioral categorization. Systems rarely become powerful all at once. Usually they become normal first, then indispensable, then invisible. That's the pattern worth watching. And there's another layer people rarely discuss openly. A high score does not necessarily mean financial freedom. Sometimes it means someone has become highly optimized for debt compatibility. That sounds cynical, but think carefully about the incentives. The ideal participant in a debt-driven economy is not someone completely disconnected from borrowing, nor someone financially collapsing. It's someone stable enough to continuously participate. Long-term mortgage, reliable payments, ongoing consumption, predictable obligations. Economically speaking, that profile can be extremely valuable, which means the score often measures something more complicated than responsibility alone. It measures systemic compatibility, your ability to function smoothly inside expanding financial networks. And that reframes the meaning of good credit entirely, because suddenly the question changes from, am I financially responsible, to how legible and profitable am I to institutional systems? Those are not identical questions. And once you notice the difference, it becomes difficult to completely unsee it. You start noticing how many parts of modern life quietly revolve around debt access, why entire industries compete to extend financing, why economies panic when lending slows, why interest rate decisions dominate headlines globally, because debt is no longer sitting outside the economy. In many ways, it became the connective tissue holding large portions of it together, which makes the ranking systems underneath incredibly important, not just for banks, for growth itself. And maybe that explains why so many people feel simultaneously empowered and trapped by modern finance. Empowered because credit expands access, trapped because maintaining access increasingly requires continuous participation. The system gives mobility while quietly requiring dependency. And for now, most people still accept this trade because the alternatives are difficult. Try buying homes entirely in cash. Try avoiding financing in expensive cities. Try navigating emergencies without borrowing flexibility. The infrastructure of modern life increasingly assumes credit participation by default, which means the score quietly follows people almost everywhere. Not loudly, not dramatically, just persistently, in the background, until one day someone gets denied or approved and realizes an invisible ranking system has been shaping their options for years. Not because a bank manager personally judged them, but because predictive systems categorized them statistically long ago. And maybe the strangest part of all this is how normal it now feels. Most people no longer ask whether society should function this way. They only ask how to improve the number, how to move from 640 to 720, how to unlock better terms, how to gain access to slightly more favorable debt conditions, as if the objective is no longer escaping dependency, but optimizing within it. And maybe that's the real transformation. The score was never just measuring financial behavior. It was helping standardize an economy where future income could be continuously converted into present consumption. An economy where debt became scalable infrastructure, and where individuals increasingly function less like isolated consumers and more like nodes inside massive financial networks. which raises a final uncomfortable question. If modern economies now depend on ranking people according to how effectively they can sustain debt participation, then what exactly happens when large populations can no longer keep up? Because systems built on expanding credit work very differently once expansion slows. And historically, that's usually when invisible structures suddenly become visible to everyone at once.